Thank you very much. Good morning, ladies and gentlemen. I pulled the short straw for the one before lunch, so I'll hopefully keep the presentation to time and let you get out for lunch on time. Yeah. Okay. Oh, sorry. Okay. Apologies. So we'll miss the safe harbor statements. So Vaalco Energy, until recently, we were a single asset company operating just in Gabon. And we've been in Gabon for well over 25 years. To let you know, the Gabon asset remains our flagship asset for the company. Currently, we've produced over 130 million barrels from this single asset, and we continue to produce a working interest position in excess of 10,000 barrels a day just from Gabon. Last year, in 2022, we had a very successful year with significant investment in Gabon and changing out the infrastructure and an in-field upgrade where we spent over $250 million of capex. And in addition to that, we acquired a company called TransGlobe Energy that gave us a production base in Egypt and in Canada. In addition to that, we have an exploration prospect and operations in Equatorial Guinea. So what we've been looking at is how we've diversified the company from a single asset to de-risking the portfolio, de-risking the production profile, increasing our free cash flow from the assets. And again, in 2022, we initiated both a dividend structure and a buyback structure. And we currently increased the dividend to 25 cents a share for 2023. We just reconfirmed that in our Q2 earnings call. And the buyback is $30 million, and we've currently been about $15 million to date. So when we stress these numbers, the dividend at 25 cents is stressed at $65 Brent, and the buyback at $70 Brent. So we're still well ahead of the curve to make these commitments. When we look at what we're trying to do on reserves and an NRI basis, our key upside is the exploration opportunity in Equatorial Guinea. But we do have exploration prospects in Gabon and in Egypt as well, which I'll go on to as we go through each of the country structures. So we look at the key milestones and the catalysts that have been happening in 2023. So for Gabon, we recently completed a 4-well drilling program that we commenced in December 2021 and concluded in 2022. We had mixed results with that program. We had 2 very successful wells in the Gamba sands, where the wells initially were producing both in excess of 3,000 barrels a day. When we went deeper, we did some deeper wells into the Dentale sands. One was an open hole section in excess of 12,000 feet, going to a 16,000 foot TVD. And that was less successful. We found that the formations down there were far tighter. We were trying to frack into about 5 to 10 millidarcies. And to give you a comparison with that deep Dentale structure, if we look at the shallow Dentale, we're between 1 and 2 darcy. And again, in the Gamba, we've been about 1 darcy. So we've got some very, very high permeability in Gabon, which means that the wells produce very well, but they always produce immediately with water. So water handling is an issue for us. When we looked at the change out from an FPSO to an FSO, which we completed last year, the water handling issue has been much improved. And what we're seeing, and I'll come on to this, what we're seeing in 2023 is that reconfiguration has reduced the back pressure on the wells, and we're seeing enhanced production coming from the field as a result of that. As a result of that activity, we've increased our guidance, our production guidance for 2023. We upgraded that in the Q2 results. When we're looking where we are going with Gabon into the future, in 2024, we're looking to commence another drilling campaign. We're not drilling in Gabon this year. So we've issued an expression of interest to get a rig in for Q2, Q3, and we're looking at a 3 to 4 well program with options. Further upsides in Gabon for us look at exploration activity where we're partnering with a company, BWE and Panoro, on blocks G and H, which are adjacent to our Etame block. So it allows a good step-out opportunities. allows us with some tieback opportunities to existing structures, so we're quite excited about the prospects for exploration in Gabon going into 25. As I mentioned, last year we successfully completed the acquisition of TransGlobe, which added Egypt and Canada to our asset base. We've just completed a firm 12-well program in Egypt, and I'll give you some results of that later in the presentation, but it was very successful. We've reduced our drilling and completion times from an average of 38 days down to 15 days. With the result of that, we've basically completed our firm drilling program with reduced capex, and again, as a result of that, we've managed to reduce our capex forecast for this year and our guidance, but maintaining our well profiles, and our production profiles have increased. We have potentially 3 additional wells that we're looking at right now in Egypt because the campaign has been so successful. With this drilling rig, we're planning to probably optimize by drilling 3 additional wells, but that will still be within our existing capex guidance. When we look into 24 and 25, in 24, we're looking at a similar drilling program in Egypt, probably commencing in the second half of the year with between 12 and 15 wells, excluding workovers. We do quite a lot of workovers just to maintain production. And in this program next year, we'll include exploration prospects for tiebacks into the various production facilities. In Canada, post-acquisition, we spent some time right-sizing that business because it was, we thought, a bit overburdened on the G&A side. So we've done that now, we've completed that. We've had a very successful drilling and completion campaign with the 2 wells that we've completed this year. They both came in above pre-drill forecasts, and they continue to produce above pre-drill forecasts. So again, in Egypt, in Canada, we've had record production in both of these locations in the last 6 months. What we have done in Canada is we've looked at optimizing the position to 2.5 to 3 mile laterals only. The 1.5 mile laterals we will only drill to retain the land, but they really are not as economic as the opportunities in the 2.5 to 2.75 mile laterals, and that will be our focus going forward. In Equatorial Guinea, we've got a sizable block. We have a position where we have a discovery that was discovered by Devon Energy in 2002. It's about 25 million barrels of 2P, about 16 million of 1P. We're just finalizing parts of the JOA. We've got a plan of development approved with the government. And in 2024, we look to go into FEED studies and take it towards FID. Drilling for that will probably commence in 2025. It's a deep water location, but we're drilling it from the shelf. So we're drilling a deep subsurface target, but from a shallow water location, which is about a 3.5 kilometer long reach position, which is not as long reach as you've seen in some of the wells more recently. But for us, this structure makes it a very economic project rather than going for a floater on a vertical drill. When we've been looking at the combination and where we've been on synergies and some of the commitments we made last year on the acquisition, as you can see, the immediate cost synergies have all been achieved, $3 to $5 million per annum. The medium-term cost synergies we're still working towards, but I think it comes up later in the slide, when we did our Q2 comparisons, on a year-on-year basis, we have reduced G&A by $13 million between where the companies were standalone. So there's a significant efficiencies coming through on G&A, and we're well on target to give that $30 to $50 million over the next 5 years. Recent highlights, I mentioned the reduction in the G&A, reduction in our guidance for CapEx down by $10 million, an increase in our guidance to production, increasing to 19,000 barrels per day NRI for the year. And currently, with the return on buyback and on dividend, it distributed 128% of free cash flow for the first half of this year. We were comfortable and confident in doing that because we have a lower capex program in the second half of the year and expect to generate significant cash in that time frame. So some of our key metrics, this is our Q2 metrics. We see the change on Q2 2022. Production up, our EBITDAX up 37%. Our diluted earnings per share up 100%. And the investment in capital, the shareholder return up 5%. We were delivering around about a 6% yield, but we've had a recent kick up in stock price, so that's probably about 5% yield now when you include the buyback. And as I said, the buyback program has been approved to continue for this year, as has the dividend. These are things that we've introduced in the last 18 months and showing a reasonable return to our investor base. And we've seen a reasonable move in the share price position. I'll focus a little bit on the assets. So Etame, we've been there for 25 years. We have about 60% working interest. It's in about 130 meters of water. We have 4 platforms, 1 FSO. It is, and we've been, like I said, we're drilling there last year. You can see the 3 main fields between Aburi, Avuma, and Etame main. There are deeper structural opportunities in the Dentale. It's a mature asset, but it keeps giving. So, I mean, we're still, the gross production still holding it close to 19,000 barrels a day. And as I said, because of the field reconfiguration, we've reduced the back pressure, and therefore our decline curves have improved, and therefore allowed us to increase the production forecast for 2023. When we look at Gabon, again, Q2, we're 100% oil, there's no NGLs or gas. The gas that we do produce, we use for field gas, reducing our carbon footprint. We're looking at only a slight decline, despite the no drilling activity. And we're looking at a very strong performance in 2023 when you compared to the uptime position that we had in 2022. Now that uptime is because with a much more modern vessel in for the FSO, we have reduced the maintenance campaign considerably, and that's allowed us to have, again, in addition to the extra production from the reduced back pressure, we've got extra production from better uptime. In Egypt, we've had quite a marked improvement in efficiency. So it's quite a heavy oil, 21-degree API. We've improved the drilling efficiency, and what the previous management team did pre-acquisition, they consolidated the concessions into a single concession. That was worth a considerable amount of money because it moved all the cost pools into a single aggregated area. That allowed the concession holder to have a much higher oil entitlement and therefore an opportunity to improve their production position. There's been a lot said about Egypt. It's going through a tough time just now economically, and it's we in the second quarter had already forecast to have a working capital increase. But I think what's important and what's somewhat unique for this particular concession that we operate is that we do have the right to export. So not everything that we produce is domestically sold. So we currently export up to 3 cargoes a year. We had a cargo exported in January. And when we export these cargoes, they go to the global market. So the money is outside Egypt, it's sold globally, and it comes back to Houston. So it's not a domestic sale. And the domestic sales, they tend to be at a lower price than international sales because of the quality balancing. So every time we get a cargo, we're probably between $5 and $7 per barrel benefit to a cargo. That helps us keep our working capital position in check because we can, as I say, we've got a cargo this month and we're working with the government to get the cargo for Q4. And that allows us to continue our investment profile in Egypt. Again, when we look at the drilling improvement, it is really a marked improvement. So one of the questions I've been asked is how do we achieve that? It's done in a number of ways. One, we've forced operating efficiencies into the joint venture. We've repurposed a number of individuals into that joint venture to focus on efficiency. We've also worked closely with the supply chain to make sure that as the rig times are improving, there's no point in improving the rig times if it then sits for 15 days waiting on equipment. So the supply chain had to be improved ahead of the drilling efficiencies, and we managed to achieve that throughout this year. And that gives us the confidence. As I say, we're now drilling and completing in 15 days. So we completed our last firm well last week, and we've already started drilling our next contingent well, which I'm traveling to Cairo next week, and it's probably going to be complete before I get there, which is, shows the types of momentum we have ongoing. So in here, we've included within our CapEx these contingent wells, but we've erred on the side of caution and not included it in our production guidance at this time. But we'll give the market an update as we complete these 3 wells. Canada, you saw in the first slide that we're an African-focused business, and where does Canada fit into that? Well, it came with the acquisition. We spent a lot of work. It's just outside Calgary in the Harmattan area. We're a very small operator in Canada, and scale is important. However, having right-sized that business now, both from a G&A standpoint and an activity standpoint, the business is turning around very nicely. Having made the decision to focus on the longer laterals rather than the shorter laterals, that means that we can more target the economics that will ensure that the business can give a return back to shareholders through the headquarters opportunities. So again, as I said, in right-sizing that, we've managed to have record production in Canada, and in 2024, the program looks to build on that 3,000 barrels a day that we're currently producing in Q2. So a very successful operational position in Canada, a mixture of gas, NGLs, and oil production, which does give us a little bit of a skew on the pricing. But that being said, we've been very pleased with the activities of the management team that we put in place up there for the first 6 months in a difficult environment. Equatorial Guinea, I mean, this is a very large block, and you can see from the map there, we've got a couple of discovery prospects and a very large exploration prospect. So just where the Venus discovery is, in the center of the block there, that's where the subsea bed shelves off. So just to the east of that discovery, it goes up to the shelf, and it shelves to about 130, 140 meters. So where you could basically put a jack-up rig in place on top of the shelf and drill subsurface down to the Venus discovery. The Venus discovery itself sits in 1,100 meters of water. So at 25 million barrels, a typical floater drill and FPSO development would be sub-economic. What we challenge for the technical solution here, can we do it from the shelf, and then can we get the wells, the production unit also on the shelf to make it economic? And we've got it there at about between $12 and $15 F&D cost. That was the target. That's where we put it in place, and that's where we've started on the plan of development. What we're looking to try and do is, how do we improve that? How do we reduce that plan of development cost down below the level we have at the moment, and get it into an FID position that makes it an attractive option? We've got forecasts on this opportunity that in production this would do anything between 15,000 to 17,000 barrels a day, and we've got a 60% working interest in that. But what it really does is that starts to fund the opportunity for a big exploration play out on that big yellow blob you see there, Southwest Grande, which is a deep water play, which would make a significant difference to the company's profile if we were able to successfully drill one of those wells. And it crosses over with a block on the other side, and we're in discussions with the owner of that block to perhaps do a joint well on the lease line. So there's lots of upside in Equatorial Guinea. When we look at where the company is, we're completely debt-free. We have around $50 million of cash with a rising cash balance in the second half. We've got a debt facility that we don't use. It's there purely for insurance So total liquidity of about 100 million. You can see what we've done with the dividend program, stepped it up as we committed to from where it was in 2022 up to 2023, and the Q3 dividend has been declared and confirmed and will be paid in September. And in addition to that, we've got the share buyback program that continually runs and will run throughout this year up to 30 million, and we'll make a decision as to where the stock price is and where our cash balances are versus investment as to how we continue that. Our netbacks at various oil prices. So this is a granulated netback position, but at $80 oil, we're around about $25, $26 all in. But we're still just under $20 on 70. This is on dated Brent pricing. So the company is in a profitable position. It has significant volumes as to where we were in 2022. As I said, up 137%. And with the acquisition, and now that acquisition being bedded in, it is beginning to give us the levels of efficiencies that we were looking for when we initiated this takeover. I'll finish on ESG. We do a lot of ESG work in Africa. We spent a lot of time in Egypt putting secondary containment in all the production facilities which weren't there before. We've do significant ESG work in Gabon with a number of social programs in place, both for communities and for the wildlife there. We've got a program for the development of crops and the avoidance of the elephant population, which it sounds a weird thing to say here, but an elephant population causes a lot of damage to the farmers in Gabon. And we've been investing in making sure that the crops are there every year. And you can see on the environmental side, we also have issued our 2022 ESG report. It's on our website. It shows continual improvement in our GHG emissions and on our baseline tracking. And I'm just 2 minutes over, but hopefully I'll see anyone for questions in the Q&A session. Thank you very much.